The effects of the Iran war are widespread, impacting everything from energy costs to the supply of specific goods like pharmaceuticals and electronics. Let's take a closer look at the general economic and supply chain disruptions caused by the conflict based on very recent reports. Perhaps the most immediate and severe effect is the disruption to the Strait of Hormuz, a critical waterway for about 20% of the world's oil and gas. This has led to several significant knock-on effects. We are seeing soaring shipping costs as major carriers suspend crossings. This detour can add 10 to 14 days and roughly $1 million in extra fuel costs per vessel. Freight rates for very large crude carriers recently jumped 94% in a single weekend. Naturally, energy prices have surged as well. Brent crude hit between $82 and $90 per barrel, up from $66 at the beginning of February. Analysts warn that a prolonged conflict could push prices above $100 or even $150 per barrel. Natural gas markets are also under significant strain. However, the effects extend far beyond energy. The ripple effects are being felt across a wide range of industries. The chemicals and fertilizers sector, for example, is feeling the pinch. High oil and gas prices increase feedstock costs. Fertilizer trade itself is disrupted, given that 44% of the world's sulfur and 31% of its urea transits the region. The pharmaceutical industry faces delays and higher air freight costs for critical shipments from India. Meanwhile, the electronics sector grapples with shipping delays and increased logistics costs for essential components like semiconductors and batteries coming from Asia. Even the metals industry, including aluminum, steel, and copper, faces a mixed impact. Some producers might benefit from higher prices, but everyone is contending with increased power and logistics costs. Chinese steel exports to the Middle East could soften. Beyond specific goods, the conflict introduces significant uncertainty into the global economy. The International Monetary Fund warns of impact on global growth and inflation. A prolonged oil price shock could push European inflation up by more than 2 percentage points and tip some economies into recession. This puts central banks in a difficult position. Persistently high prices could force them to remain cautious on interest rates or even hike again. It's also important to note that the impact isn't uniform. Downstream industries like refining and chemicals face margin pressure. Upstream oil and gas producers in places like Australia, Indonesia, and the US could actually see a boost from higher prices. So what happens next? The ultimate impact depends heavily on the conflict's duration. Analysts are currently modeling 3 main scenarios. The first and most probable is a short-lived escalation lasting less than 4 weeks. The strait might be blocked briefly. Oil could peak around $85 a barrel. The second scenario, with medium probability, is a prolonged conflict involving a longer blockade, which could send oil prices to $100 a barrel. Finally, there's a low probability but severe tail risk scenario, involving the widespread destruction of oil infrastructure, which could cause oil to soar to $130 a barrel. I hope this overview has been helpful. Thank you for watching, and please subscribe for more updates.